Well, look, I'm Rahel. We'll come back to some more questions in a sec. I think let's jump on to Vipul. So Vipul is he's our paper trader. He's our futures guy this morning. So obviously we've got Claudio's given us a high level. Rahel,
I'm selling now.
Yeah, sorry. Rahil's digging the soil. He's our producer, but we've got the man with the paper. So Vipul, obviously the open interest on sugar is, especially on New York. I mean, it's growing in London, but sugar is traded 20-30x more than is actually exists in the world. I mean, we are often at the behest of the funds of the futures market. So give us an overview of the futures markets for the audience here. What are the kind of key drivers? Who are the key players? How do the funds work? Just give us a sense of, if you can, of how this kind of complex backwater of futures actually works.
Sure. So firstly, on the open interest, it is like almost 1 million metric contracts are open in the market. I'm talking about raw sugar here. And as we have just learned that if India wants to export, they would export basis 22 cents or $570, $80. And when China was there to buy, it was around 20 cents first, then 18 cents. So who is going to play in between 18 and 22 cents? So that is the first category where the producers are at 22 cents, the buyers are at 18 cents. Then comes down the long-term players, which are the index players, who have a horizon for say 5 years, 10 years time frame, where they keep on rebalancing their portfolios. Because sugar is a very minute part of their whole portfolio.
Yeah, I mean, it's a basket of funds. Explain to us a bit more about the index funds and how they work, because that's such a key driver.
So index funds hold almost 25% of the open interest, and they are mainly long-only funds. So they look out the values in dollar terms for the particular commodity, and every year during the first week of January they evaluate, like, is it a right time to book out profit in that, or you want to reinvest or increase your positions in that, because they are not looking for the daily fluctuations or quarter to quarter trade flows or even annual trade flows. They look out for 5 years, 10 years, where they make a judgment that this commodity should be rising up within 2 or 3 years. So if we take the case like sugar, since I've been trading since 2010, it was at 34 cents as well, and it was down to 9 cents as well. So index funds play out where they can maximize up to 50% of their returns in particular commodity. And sugar would be like 3 or 4% of the whole portfolio in the commodity space. So commodity space is like overall say 10% or 12%, apart from the other asset classes. In that, sugar would be 10%. And then rebalancing happens. Suppose like if coffee was really very high this year, and they would have bought around say like $3,000. It's trading at $5,000 as of now. So they are already making like 40% or 50% or more than 50% actually, 50% of the returns. So they will be reducing their positions in coffee, entering into the other commodities, grains in particular, which has been on the lower side since last 2 years.
Grains, everything, yeah.
So they would be entering on the long side from that. So they will keep on rebalancing their portfolio.
Because it's long only, right? So they have
long
to.
only.
Yeah.
Yes.
Yeah.
So they play a major role in providing a cushion to the market when it drops down drastically.
I mean, I guess as a trader, and Rahel will I'm sure second me here. Sometimes we find ourselves pulling our hair out because you think you've got the market sussed out, and then the funds come in with a view on a piece of news or a tweet or something like this, and the market goes ballistic, completely contrary to really what is actually happening. I mean, what are the key drivers? What is it that gets these guys really revved up and then it gets them to dive back in? What do you see, and how do you deal with that that volatility as well?
That is the most exciting part of the day when they come down and have interactions. But just to clarify, the first part which I talked was about index funds, not the funds fund. So index funds are long tenure ones. But when we come down to the third category, first was commercial, second is the index one, third category is the funds category, which take a view and they attend conferences, they look at the SNDs, they have their own research in-house and look out for where the opportunity is. So given that when market had sensed that the supply is going to be really very hard on the markets, the funds started selling off their longs. They were almost 250,000 lots long. That is again like 25% of the open interest on one side. They started selling. They sensed that there is still heavy and the demand is still there. So their selling was being lifted by actual buyers. as the case 18 to 22 cents. That 20 cents, China was there. They sensed it, they stopped buying there, they stopped selling over there, the market bounced back to 22 cents. Then it was a level where the Brazilian mills were very happy for this season, which is ongoing, when the market had come up to 23.
Started pricing.
Started pricing in. Then it was like they knew this is the range of the market, we can have it both the sides. When the market came down to 20 cents, they were still aggressive, they didn't find any Chinese buying in the market. They started increasing their positions because they knew that Brazilian mills, which has a tenure of say 3 months against their production, when their window for hedging is open for the smaller mills, but that is also a huge production to hedge. So that also created a lot of pressure, and market was below 18.5 cents. In touch base 18 plus minus 10 ticks, 20 ticks up and there. But at that time, again China was there in the market. They were almost 270,000 lots short in the market, the fund side.
Yeah.
They sense China is there, let's start covering back.
And then you get these daily swings of, you sometimes get a cent in a day, and it does get.
There comes the fourth category, that is the speculators.
There you go, exactly.
Yes. So speculators play a very important role in providing daily liquidity. If they sense that there are some algos trading or there are stop buys or stop sells in the market, that is where they try to outrun. And they provide ample of liquidity. They try to find out where in the spreads, say suppose like if you're talking about Ockmart spread for next year, 2025-2026, which does not has any liquidity. Bid ask is also 2 ticks wide, which is relatively not so easy to find in sugar market. But then when they sense it out, they start playing on the algo side. They will make 2-3 ticks on the spread, buy out here, sell out on the buy on the October, sell on the March, and do the reverse on the spread. Because spread is a little bit liquid as compared to the flat price, and open interest in the backward months is really negligible.
Correct.
On the raws as well. But when it comes down to a combined as a, say like if a fund is trading on the whites as well and the raws, because it cannot be on a standalone basis, so they look out at the prices in which the millers or the refiners would be so much compelled that they don't want to hedge over here. They will bring down the market to such levels where they would be the left out players in the market. So there are many scenarios where we have seen that white premium has fallen down around to $50, where nobody is hedging it out from the refiner's side. But why was it at 50? Who sold it down till 50? Right? So those are the players which provide liquidity in all the cases, whether it is on the upside or downside. And if I say more, then like when the funds were 270,000 lots short, market was 18.5, and our research was very, very aggressive in suggesting that market range should be between 20 and 24 cents. That is the point where to whom we interact to, we suggested that you should be covering back your positions and start to looking to build up the longs.
It feels like good value at 80.
Yes.
Anything,
It appears
teams
now.
in front
It
of
appears now. But then, if you will believe in the ethanol parity and 44 million or 43 million metric ton of Brazilian production, then 18 would be a very high price. You would be talking about 15, 16 cents.
I want to add something.
jump in.
Yeah. So we always make a lot of discoveries in this market, and how low can we go or how high can we go. You were talking about, let's say, a white premium at $50, $55. Now, Thailand, for example, they are not maximizing, I would say, white sugar production at the beginning of the crop because it's easier to do rows. But Thailand has a specific industry, they have such a cold thing that, so you call it remat, remat. What is this? You do the rows, you do the syrup, you do this. And then at a certain point in time, after the crop is over, you can still decide, can I do white sugar instead?
Right.
And they will look at the white premium. Now, believe me or not, they can operate at white premiums at $60 or $55. Okay, so then we will discover this into this market, and then because everybody say, yeah, we got used with white premiums at 120, 130, 140, right? But look, we can go so low that we discover these people bringing it. Of course, they will not bring massive quantities. They will not remelt now 3 million tons at 55 or at 60, but they will be there at least for 1 million tons if needed. So that's what these people are bringing to the market. Rediscovery, rediscover yourself. And there are also refineries already that are happy with 7.
True.
Okay, some of them they are happy 65, 70.
Right.
They will still be there probably.
Right. So just to add to like what I was saying about the funds, it's like they understood that the raws are there in the deficit for Q1 next year, and whites are in surplus. So trade was to cover up back all the shorts on the raws, pump up the market, and they were sitting long on the whites as well.
Well, I mean, we've just seen the biggest open interest in White's history, right? You know, I
Right.
mean, that what does that tell you? The funds have finally woken up to the fact that London is quite an interesting market.
They have got a little bit stuck in that position, to be
Yeah,
honest.
I'm
So,
not
but then
surprised.
they are not losing out money now.
Yeah.
Because they were sitting short on the ROS, which they pushed up very, very strongly from 18.5 till 23, 22, 23, and they were still holding on to the longs, and the market was giving them an incentive to carry the longs because of the spread, right? So $10-15 of her money was made in the spreads, and so that has given quite a big liquidity in the market on the whites as well. Whites is just 100,000 lots of an open interest.
Yeah.
If you want to sell out 100 lots, that would also take
It takes time.
it takes time.
Yeah.
But then if you want to sell out 100 lots in raws, you say and it's done.
And